The American economy is hanging by a thread, and when it snaps, the fallout won't start with small businesses. It will devour the giants. Companies once worth tens of billions of dollars are now sitting on mountains of debt, broken business models, and razor-thin margins. Think $43 billion in corporate debt, stock prices that collapsed from $400 to pennies, and industries addicted to consumer spending that's about to vanish. When the crash hits, these so-called titans will be the first to fall. This isn't speculation, it's financial gravity. Number 10. WeWork. WeWork was once valued at a jaw-dropping $47 billion in 2019, hailed as the future of office space. Today, it's a case study in corporate collapse. Even after restructuring, the company carries billions in debt, and its entire business model is brutally exposed in an economic downturn. At its core, WeWork leases office space long-term at high fixed costs, then rents it out short-term to startups and freelancers. In good times, that sounds flexible. But in a crash, when small businesses fold and companies downsize, WeWork is left paying massive lease obligations without steady tenants. After filing for bankruptcy in 2023, the company tried to shed leases and cut costs, but it still has over $10 billion in long-term lease commitments. That's a ticking time bomb. If the economy contracts sharply in 2026, vacancy rates in co-working spaces could skyrocket past 50%, leaving revenue streams bone dry. Investors already have little faith. The company's stock once plummeted from $400 a share pre-split to trading under $1 before delisting. That kind of collapse doesn't just hurt shareholders, it signals a broken business model. The shift toward hybrid and remote work makes matters worse. Major corporations from Meta to Amazon are reducing office footprints, not expanding them. If big companies don't need space and small businesses can't afford it, who's left to fill WeWork's glossy glass walls? Landlords aren't exactly forgiving. Defaults on leases could pile up, lawsuits could follow, and cash burn could easily exceed $500 million annually during a downturn. In a crash economy, flexibility won't save WeWork, it will crush it. The same model that made them famous will leave them holding empty buildings, unpaid bills, and no way out. Number 9. Carnival Cruise Line. Carnival Cruise Line was once the crown jewel of vacation travel, but beneath the glitter of ocean sunsets and luxury buffets lies a staggering mountain of debt. As of 2025, Carnival is drowning under $31 billion in debt, much of it borrowed to survive the pandemic shutdowns. Even with cruise demand rebounding, interest payments alone are costing the company over $1.5 billion annually. In a healthy economy, Carnival can limp forward. But if the economy crashes, this debt load becomes a noose. Cruises are not essential spending. When families tighten budgets, the $5,000 Caribbean getaway is the first thing canceled. Even a 15 to 20% decline in bookings could turn Carnival's fragile cash flow into a financial disaster. Add rising fuel costs, which already eat up 15% of operational expenses, and the picture gets darker. Carnival also faces stiff competition from Royal Caribbean and Norwegian Cruise Line, both of which are investing heavily in newer ships, while Carnival still struggles with older fleets and costly maintenance. Operationally, it's not just about ticket sales. Onboard spending, which makes up nearly 30% of Carnival's revenue, drops sharply when passengers cut back on alcohol, excursions, and luxury extras. And with inflation still squeezing consumers, who's going to splurge on cruise cocktails when groceries at home are already breaking the budget? If the economy crashes, expect a brutal domino effect. Bookings decline, debt servicing skyrockets, and investors flee. Carnival could be forced into another round of restructuring, or even bankruptcy protection. And unlike airlines, which often get government bailouts, cruises are seen as luxury industries. There's no too big to fail safety net. Carnival's massive ships may still sail, but financially they're heading straight toward an iceberg if the economy sinks. Number 8. Paramount Global. Paramount Global, owner of CBS, Paramount Pictures, and its struggling streaming platform Paramount Plus, is a media giant running on fumes. At first glance, Paramount looks stable, with over $28 billion in assets, but dig deeper, and you'll find $15 billion in debt paired with collapsing revenue streams. Traditional cable subscriptions, once Paramount's lifeline, are falling at an alarming rate of 6 to 8% per year, and advertising revenue has been shrinking by over $1 billion annually as viewers shift to digital platforms. Paramount tried to reinvent itself with streaming, but Paramount Plus has turned into a cash pit. Despite spending nearly $6 billion annually on content, subscriber numbers still lag far behind giants like Netflix and Disney+. In a recession, when consumers cut back on non-essential subscriptions, Paramount Plus could lose millions of users. If even 10% of its subscriber base cancels, that could wipe out hundreds of millions in annual revenue. Movie studios aren't safe either. Box office sales are notoriously recession-sensitive. A global crash could slice theatrical revenue by 20 to 30%, leaving Paramount Pictures bleeding cash from blockbuster flops. Worse yet, Hollywood's competitive streaming wars mean there's little room for error. The company simply doesn't have the cash cushion of competitors like Disney or the diversified empire of Comcast. Adding to the crisis is Paramount's exposure to rising interest rates. Servicing billions in debt already costs the company nearly $1 billion per year, and refinancing during a crash could push it higher. Credit downgrades are looming, and if investors lose confidence, Paramount stock, which already trades at lows compared to its 2014 highs of $60 plus per share, could tank further. In short, Paramount is fighting a three-front war: collapsing cable, bleeding streaming, and uncertain box office revenue. If the economy crashes, this media empire could be the next giant forced into fire sales, asset spin-offs, or outright bankruptcy. Number 7. Delta Airlines. Delta Airlines is often praised as one of the stronger U.S. carriers, but even giants fall hard when the economy crashes. Air travel is deeply tied to consumer spending, and when households cut vacations and businesses slash travel budgets, airlines feel it instantly. During the 2020 pandemic, Delta lost $12.4 billion in a single year. That vulnerability hasn't gone away. As of 2025, Delta is carrying more than $20 billion in debt, much of it tied to aircraft financing and pandemic survival loans. Just servicing this debt costs over $1 billion annually. If the economy sinks, demand for leisure and corporate travel could easily fall by 20 to 30%, wiping out billions in revenue. Unlike budget carriers, Delta relies heavily on premium travel. If businesses cut corporate flights, those high-margin first-class seats go empty, a devastating hit to profits. Fuel costs make the picture even riskier. Jet fuel accounts for nearly 25% of Delta's total expenses, and prices remain volatile. If oil spikes during a downturn, Delta faces the double blow of higher costs and weaker demand. Add in labor pressures, with pilots and crews demanding wage increases, and Delta's operating costs are rising even as margins shrink. Another weak point: international routes. Delta has expanded globally, but recessions hit international travel hardest. Routes to Europe and Asia could see passenger declines of over 30%, turning profitable routes into money losers. Even loyalty programs, often seen as airlines' hidden goldmine, lose value if passengers stop flying. Delta's market capitalization once topped $60 billion pre-2020, but today sits closer to $25 billion. Investors know this is a fragile business. If the U.S. enters a severe recession, Delta could be forced into mass layoffs, fleet downsizing, or even government intervention. Delta's slogan is "Keep climbing," but in an economic crash, this airline may find itself grounded faster than its passengers ever expected. Number 6. Warner Bros. Discovery. When Warner Bros. Merged with Discovery in 2022, it was hailed as the creation of a global content powerhouse. But behind the glossy red carpet premieres, Warner Bros. Discovery is saddled with a crushing $43 billion debt load, one of the largest in media. Servicing this debt eats up nearly $2 billion annually in interest, leaving little flexibility for growth. If the economy crashes, that mountain of obligations could quickly bury the company. The streaming war is already brutal. HBO Max, rebranded simply as Max, has around 100 million subscribers, far fewer than Netflix's 270 million. Despite investing nearly $20 billion annually in content, revenue growth hasn't matched spending. In a downturn, streaming subscriptions are among the first household expenses to be cut. If even 10% of Max subscribers cancel, Warner could lose over $1 billion in annual revenue. On the film side, Warner Bros. Has relied heavily on blockbusters like The Batman and Dune. But theatrical revenue is highly recession-sensitive. A global crash could easily slash box office numbers by 20 to 30%, turning billion-dollar productions into massive losses. Advertising, another core pillar of Discovery's legacy TV channels like HGTV and TLC, is already in decline. Ad sales fell 14% in 2024, and recessions always accelerate those cuts. The company has also engaged in controversial cost-cutting, shelving projects like Batgirl to take tax write-offs. While this reduces short-term costs, it signals financial desperation. Investors have noticed. Warner Brothers. Number 5. Rite Aid. Rite Aid is a pharmacy chain that should be thriving in an era of aging populations and high demand for medications. Instead, it's teetering on collapse. The company filed for bankruptcy in 2023, but its problems remain staggering: over $3.3 billion in long-term debt and more than $1 billion in opioid-related legal liabilities. In an economic crash, these pressures could finish what bankruptcy started. Rite Aid operates around 1,600 stores, but closures are accelerating as the company struggles with falling foot traffic. Unlike rivals CVS and Walgreens, which diversified into healthcare clinics and insurance partnerships, Rite Aid has failed to evolve. Pharmacies were once recession-resistant, but consumer behavior has changed. In a downturn, shoppers increasingly turn to cheaper alternatives like Walmart and Amazon Pharmacy, eroding Rite Aid's already thin margins. Operational costs are another issue. Rent, wages, and supply chain pressures keep rising, while prescription reimbursements from insurers keep shrinking. Rite Aid's gross margins hover around 22%, far lower than competitors, leaving little room for error. Add in litigation costs. The company faces over 1,600 lawsuits tied to opioid distribution, and cash flow is constantly under siege. The company's stock tells the story. Once worth over $180 a share in the late 1990s, split-adjusted, Rite Aid trades today for pennies. That collapse reflects not only investor skepticism, but also the market's recognition that Rite Aid has no viable long-term strategy. If the economy crashes, customers cutting back on non-essential purchases like beauty and convenience items could gut Rite Aid's front-end sales, which account for nearly 30% of its revenue. Without a strong healthcare arm to fall back on, Rite Aid may be forced into liquidation or a fire sale of its remaining assets. In short, Rite Aid isn't just weak. It's a dying brand that an economic collapse would likely erase entirely. Number 4. Boeing. Boeing was once the pride of American manufacturing, a symbol of innovation and aerospace dominance. Today, it's a company staggering from crisis to crisis. With more than $52 billion in debt and ongoing safety concerns, Boeing is one major downturn away from collapse. The 737 MAX disasters in 2018 and 2019 cost Boeing over $20 billion in settlements, grounding, and lost orders. While deliveries have resumed, reputational damage lingers. In early 2025, Boeing again faced FAA scrutiny after safety failures on its 737 and 787 jets, leading to production delays. Airlines may forgive in boom times, but in a crash economy, costly delays could push carriers to cancel or defer orders, Boeing's lifeblood. Commercial aircraft make up about 60% of Boeing's revenue, and demand for planes is directly tied to global air travel. During downturns, airlines slash capital spending. If travel declines by 20 to 30%, Boeing's order backlog, valued at around $450 billion, becomes meaningless as airlines delay deliveries for years. Defense and space divisions, which bring in about 40% of revenue, aren't immune either. Governments facing budget cuts often delay major contracts. Rising U.S. deficits could limit Pentagon spending, further squeezing Boeing's safety net. Meanwhile, supply chain costs remain high, and labor disputes continue to plague production lines. Cash flow is already fragile. In 2024, Boeing burned through nearly $3 billion in free cash, and with debt servicing costs above $2 billion annually, it has little cushion. Its stock, once soaring at over $440 per share in 2019, now struggles around $170. Investors clearly see Boeing as a high-risk bet. If the economy crashes, Boeing faces the nightmare of plummeting aircraft orders, rising costs, and limited government support. Unlike 2008, when airlines rebounded quickly, today's structural issues could leave Boeing grounded permanently. Number 3. General Motors. General Motors was once the face of American industrial strength. But history may repeat itself. Just like in 2009, when GM needed a $50 billion government bailout, the automaker is once again vulnerable. Today, GM carries over $110 billion in debt and liabilities, much of it tied to pension obligations, supply chain costs, and the expensive shift to electric vehicles. EV competition is fierce. GM has pledged $35 billion in EV investments by 2025, yet it lags far behind Tesla and Chinese giants like BYD. If the economy crashes, demand for expensive EVs, already priced around $45,000 to $60,000, could dry up overnight. Consumers who might stretch for a new Cadillac Lyriq or Chevy Blazer EV simply won't when their job feels shaky. Labor costs also weigh heavily. After the 2023 UAW strike, GM agreed to higher wages and benefits that will add billions in long-term costs. In a downturn, when car sales decline by 20 to 30%, these labor obligations become financial anchors. Add volatile raw material costs for batteries, lithium, cobalt, nickel, and GM faces rising expenses with shrinking revenue. Global operations are no safer. China, GM's second-largest market, has seen declining sales due to domestic EV competition. If a global crash hits, GM risks losing billions more overseas. GM's stock, which peaked above $65 in 2021, now hovers closer to $30. Investors already sense weakness. If the U.S. economy contracts sharply, GM could face plunging sales, shrinking margins, and potentially another government rescue. Unlike in 2009, political will for a bailout may not be as strong. In a crash, GM isn't just competing against Tesla and BYD. It's fighting against its own history of collapse. Number 2. AMC Entertainment. AMC was once America's movie theater king, but today, it's closer to a meme stock propped up by hype than a viable business. The numbers tell a grim story. AMC carries nearly $9 billion in debt, and interest payments consume more than $500 million annually. In a crash economy, that's unsustainable. Theater attendance never fully recovered from the pandemic. In 2019, AMC sold about 350 million U.S. tickets. By 2024, that number was down to under 250 million. Streaming has permanently changed consumer habits, and households cutting costs during a recession won't splurge on $15 tickets and $10 popcorn. Even blockbuster films don't guarantee survival. A single flop can sink revenue projections for an entire quarter. In a crash, studios may delay expensive releases, reducing AMC's content pipeline. Concessions, which make up 30% of AMC's revenue, also collapse when attendance drops. That's devastating because margins on snacks are far higher than tickets. AMC has tried gimmicks like renting out theaters for esports or special events, but these add little to the bottom line. Investors know it. AMC stock, which meme traders pushed above $70 in 2021, now trades under $5. The hype bubble has burst. If the economy tanks, AMC faces a brutal scenario. Fewer moviegoers, falling concessions, heavy debt, and no clear diversification strategy. Unlike streaming companies, AMC has no digital pivot. Unlike theme parks, it has no alternate revenue streams. It's a one-trick pony in a world where people can stream Netflix for $15 a month. AMC may still light up the marquee, but in an economic collapse, the curtain could fall permanently. Number 1. Tesla. Tesla is the crown jewel of the EV industry, but it's also one of the most fragile giants if the economy crashes. The company's valuation, once peaking at $1.2 trillion in 2021, still trades at an eye-watering $600+ billion in 2025, despite declining margins and rising competition. That inflated valuation is built on confidence, and confidence evaporates in a crash. Tesla relies heavily on consumer demand for premium vehicles. Its best sellers, the Model Y and Model 3, average $40,000 to $55,000. In a downturn, buyers delay big-ticket purchases, especially cars financed with loans. With average car payments already near $742 a month, rising interest rates make Teslas even harder to afford. A 20% decline in EV demand could strip billions from Tesla's revenue. Competition is Tesla's other Achilles heel. Chinese EV makers like BYD and NIO are already outselling Tesla in China, the world's largest EV market. In the US, Ford and GM are ramping up production. In a crash economy, lower-cost alternatives crush Tesla's premium-focused strategy. Margins are shrinking too. In 2022, Tesla had profit margins near 17%. By 2025, those margins slipped below 10% as the company slashed prices to maintain demand. A global downturn could push Tesla into unprofitability for the first time in years. Meanwhile, Tesla carries over $5 billion in long-term debt and is tied to Elon Musk's reputation. Investor confidence is deeply linked to Musk's brand. And if markets crash, even minor controversies could trigger massive sell-offs. Tesla's stock is already volatile. A 50% price collapse during a recession wouldn't be shocking. Tesla may be the most innovative car maker of its time, but it's also one of the most overvalued and vulnerable. If the economy crashes, Tesla won't just stumble. It could see its empire unravel almost overnight.